Hello guys. So this is AS13 investment continuation part 2. In part 1, some of the explanation is not captured in the video, so I will try to explain those portion now, and later on we will move to the problem session. Okay. I think the point number 4 cost of investment, and point number 5 is missed out in the previous video. The video did not capture properly, so I will explain again. So the point number 4 is when interest has accrued in pre-acquisition period and was included in cost of investment at the time of acquisition, the subsequent receipt of such pre-acquisition interest is deducted from the cost of investment. So what is the meaning? We are in cost of investment. We already discussed cost of investment. What is the cost we have to identify for the particular investment? So what they are trying to say here is, when I am buying one security or some shares or some debentures. So if I buy a debentures, while buying the debenture, there is an interest element which is already included in the debenture. For example, cum interest debenture. Hope you heard this. Cum interest, X interest. While I am purchasing, the interest already accrued some portion on the debenture which is included in my debenture cost. For example, actual debenture cost is 100 rupees. Actual debenture cost is 100 rupees. But I am paying 103 rupees. Why I am paying 103 rupees? Actual debenture is 100 rupees only, but extra 3 rupees I am paying. Why? Because this 3 rupees and interest accrued already on the debenture, but it is not due presently. It is due after some time. While the seller is selling the debenture, he will not sell only for 100 rupees. He will sell 100 plus 3. Why that 3 extra 3? Because interest is accrued, but it is not due. Seller will not receive that interest. Only buyer going to receive that interest. Okay, that is pre-acquisition period interest. So while buyer buying the debenture, 100 rupees is the actual price, but he will pay extra 3 rupees for that accrued interest which is not due, that is pre-acquisition period interest. Okay, 100 plus 3, 103 he will buy from the seller. After some times he will receive that 3 rupees from the company as an income. Okay, because that interest become due only after some time only. In such case, what will happen? Whatever the 3 rupees he received, it should be adjusted with the cost of investment. Okay, I'll work out better. So debenture is purchased. Okay, purchased for rupees 103. Okay, rupees 103 it is purchased. Out of this 103, 100 is cost plus 3 rupees interest accrued but not due. Okay, interest accrued but not due. So whenever the seller is selling to buyer, he will charge 103 rupees. Why? Because the 3 rupees belongs to seller actually, but since it is interest is not due, it will be paid to buyer later. So what we have to do? Buyer will receive this interest 3 rupees. For example, he purchased on 1/4/2007. Okay, interest is due on 1/5/2007. What happens then? 3 rupees he is receiving from the company. So this 3 rupees should be deducted. From the cost price. So my exact cost will be 100. Okay, 103 minus 3 equal to 100. This is what they said. The pre-acquisition, the accrued interest should be deducted from the cost of investment. Okay, so this is what they explained here. We'll go to the next thing. So what is the next one? Next one is similar to debenture only, similar to pre-acquisition period only. Here it is not debenture, it is shares actually. When I am buying the shares, what happens? While buying the share, the company is announced the dividend. But in such case, I am buying the what you can say dividend. I am buying the shares with the dividend, right? Okay. In such case, what will happen? That dividend is actually already announced based on the pre-acquisition profits. Dividend will be announced on our past accumulated profit. That past accumulated profit they are announcing dividend means that dividend should be deducted from our cost of investment. This is for initial recognition. This is for initial purchase only. Okay. This is for initial purchase only. I will explain how to, with the examples I will explain. So look at this example. X Limited. X Limited is a company where the buyer is purchasing the shares actually. So what happens on 1/4/2007? On 1/4/2007, the buyer is purchasing shares of X Limited. The worth is 1050 rupees. On this date 1/4/2007, on this 1/4/2007, X Limited is announcing X Limited is declaring dividend. X Limited is declaring dividend. Okay. How much they are declaring? 50 rupees per share. How much they are declaring? 50 rupees per share they are declaring. So what happens? A is an investor. Buying share worth of 1050 rupees per share on 1/4/2007. On this date, X Limited is declared the dividend 50 per share. What happens? He is paying 1050 rupees actually. He is paying 1050 rupees in the market and he is purchasing these shares. After some time, he is receiving 50 rupees dividend from the company, which means actually the share price worth is 1000 only. Because of the company is issued dividend. Because of the company is issued dividend rupees 50 rupees. The market price becomes suddenly 1050. You got it on what I am saying? Actual market price is only 1000. Once the company is announced a dividend, no. After that, immediately it becomes 1050. So A is purchasing and paying 1050 rupees per share. So after sometimes A is receiving 50 rupees from the company as a dividend. So what happens? So 1050 minus 50 dividend is received from the accumulated accumulated profit means 1050 minus 50 equal to 50. This is what they are trying to say. Okay. So you can expect multiple choice question from this type of thing actually. And so now you may have some doubt whether this adjustment should be made every year. I am a long-term investor. I am keeping these shares for a long period. I am in the 5th year now. I am holding this share for continuously for 5th year. This year they are paying dividend to me. Whether should I reduce from my cost of investment every year? No, this is not for the every year. This is for the initial recognition, initial identification of cost. Initially, how much cost actually we are incurring for that investment. For that only this is arrived. Every year you are getting some return. We should not be adjusted with the cost of investment. It should be credited to P&L account. If it is an interest, should be credited to P&L account. Even dividend income should be credited to P&L account. For the initial recognition, initial purchase only, what is the exact cost I paid? For that reason only this calculation is worked out. Okay. So this is what I felt that I missed out. So I am in the part 1 classes. So now I am explaining again. We will move to the problems. We will move to the few problems. We will understand the problems. So an unquoted long-term investment is carried in the books. Just I'm repeating the question again. Part 1 question is already shown. Just I'm repeating the question. So there is a company R Limited. That company is having worth investment. That company is invested 2 lakhs rupees actually. That company is invested 2 lakh rupees. Cost of investment is 2 lakh rupees. Okay. What happened? That company is announcing. That company is announcing its accounts unpublished. The published accounts of the unlisted company received in May 2017 showed that the company was incurring cash loss with declining market shares and the long-term investment may not fetch more than rupees 20,000. How will you deal with this in preparing the financial statement of R Limited for the year ended 31st March 2017? So what is the question? There is a company called R Limited. They invested 2 lakh rupees in some company or somewhere. The investment worth is 2 lakh rupees and it cost is 2 lakh rupees. That is the question. What they are trying to say, on May 2017 they are saying that the investment we made will not fetch more than 20,000 rupees. The investment they made will not fetch more than rupees 20,000 rupees. So R Limited is an investor. They invested in some company. That company they invested for 2 lakh rupees as a cost. Now the value becomes 20,000 rupees and that company also incurred huge cash loss. That company, the R Limited in which they invested, that company incurred huge cash loss, and also the market price of the shares also, as per their published accounts, it becomes 20,000 rupees. What R Limited should do in their balance sheet? That is the question. R Limited is an investor. They invested for 2 lakh. Cost is 2 lakh, and the invested company incurred huge cash loss, and they published the accounts also. That invested company published the accounts also. In that they mentioned the market share price of this share will not fetch more than 20,000 rupees. In this case, R Limited, what they should do? They are a long-term investor. Okay, so what they have to do? R Limited, just you have to think. First point, what you have to think: carrying amount of an investment, long-term investment. How to value the long-term investment? What is the value should be? We have to put in the balance sheet. Long-term investment should be valued at what cost actually? Cost means here in question, what is the cost amount? 2 lakh rupees. Long-term investment should be valued at 2 lakh rupees normally, because it should be valued at cost only. But in case of there is a decline in the value in a permanent nature of the share price. Okay, there is a permanent decline in the value of the share price. Then we have to account the revised figure. In this question, we have to understand R Limited is a long-term investor having 2 lakh rupees at cost. Now we have to check that invested company situation, whether it is a decline is permanent in nature or temporary in nature, by reading the question. So invested company is saying, sir, we are incurring huge cash loss, and also market price also will not fetch more than 20,000, means we can assume this is permanent reason. Hence we can give the solution that since based on the circumstances and based on the input data available from the published accounts of the unlisted company, they are incurring the huge cash loss, plus also the market price of share will not fetch more than 20,000 rupees. We can reduce the value and revise the long-term investment in our balance sheet to 20,000 rupees. That should be our solution. Okay, we will understand what is the solution given here. Okay, so this is the solution, as it is stated that in the question that the financial statement for the year ended 31st March 2017 are under preparation, meaning this is for R Limited actually. This is for R Limited company. They have not finalized their books actually. The views have been given on the basis of the financial statement are yet to be completed and approved by the board of directors. Also, the fall of value of investment has been considered on accounts of conditions existing on the balance sheet date. Okay. What is the thing? Investment classified as long-term investment should be carried in the financial statement at what? At cost only. Okay. At what? Normally at cost only. However, provision for diminution should be made to recognize a decline other than temporary in the value of investment, such reduction being determined and made for each investment individually. What they are trying to say, generally it should be valued at cost, but we have to give provision for loss reduction in the value of investment if it is permanent in nature. If it is permanent in nature only. So AS 13 determined and made for each investment individually. Sorry, AS 13 accounting for investment state that indicators of the value of investment are obtained from reference to its market value, the investee's assets and results of the expected cash flow from the investment. On this basis, the facts of the given case clearly suggest that the provision for diminution should be made to reduce the carrying amount of long-term investment to rupees 20,000 in the financial statement for the year ended 31st March 2017. Okay, this is the solution. Based on the above facts, we have to reduce the value of long-term investment to 20,000 rupees, but we have to add one more point here. What is the loss here actually? What is the reduction in the value of asset? Actual value is 2 lakh, but we are revising it to 20,000. So 2 lakh minus 20,000 equal to 1,80,000 rupees loss. That should be debited to P&L account. That also you have to write here. Okay. Along with this answer, you have to write one more point. Rupees 1,80,000 rupees decline in value of the asset should be debited to P&L account. Okay, that should be the answer. Go to the next question. So X Limited on 1/1/2017 had made an investment of rupees 600 lakhs. X Limited, a company, they are making investment worth of 600 lakhs. Assuming this is cost. Okay, cost of thing is 600 lakhs in equity shares of Y Limited. X is investing in equity shares of Y Limited for 600 lakhs is the total amount. 600 lakhs is the total amount, of which 50% is made in the long term category and rest as temporary investment. They are making out of 600 lakh, they are classifying into two categories. One is long term and the other one is short term, that is current investment. Long term investment, current investment. Long term investment 50%, current investment 50%. Okay. Then what is the next thing? The realizable value of all such investment on 31/3/2017 becomes rupees 200 lakhs as Y Limited lost of case of copyright. Because of Y Limited lost one case against them, the market value of shares becomes reduced from 600 to 200. 600 lakhs is the total value. It becomes 200 lakhs now. Okay. From the given market condition, it is apparent that reduction in the value is not temporary in nature. Question itself, they are saying this reduction in value is not temporary, it is permanent in nature. Question itself, they give the answer actually. How will you recognize the reduction in financial statement for the year ended 31/3/2017? This is the question. So what they are saying, first of all, we have to understand what is the carrying amount for long-term investment, what is the carrying amount for current investment. That we have to understand first. Okay. So X Limited is there. Okay, X Limited is investing in Y Limited for 600 lakhs. 600 lakhs, out of which 50% is long term, 50% is current investment. So 600 into 50% is 300 lakhs. 600 into 50% is 300 lakhs. This is the question actually. What we have to do now? We have to identify carrying amount of current investment. Carrying amount of current investment first we will identify. Okay. Carrying amount means generally what is the amount we should present in the balance sheet. Remember our part 1 discussion. Carrying amount of current investment is lower of what and what? Lower of cost, lower of cost, realizable value. Okay. Cost is how much? 300, correct? Because we arrived here 300. Realizable value how much? We have to identify. what happens as per the question? What happens as per the question actually? As per the question, on the balance sheet date, what happened? On the balance sheet date, this total 600 lakhs becomes 200 lakhs. This total 600 lakhs becomes how much? 200 lakhs. That is the question, correct? And this decline is also permanent. Now this is the realizable value. 200 lakhs is the realizable value. Okay, what is the realizable value for current investment? So this is 300, this is 300, correct? 300 is from 600. So this 200, 50% we have to allocate. This 200 should be allocated in 50%. 50, 50, correct? 100, 100. Okay, so 100 here realizable value, 100 here realizable value. Okay, so the realizable value of current investment is 100. As per the carrying amount of current investment as per AS 13, lower should be, we have to take it, cost or realizable value, whichever is lower. So 100 is the lower amount, so this should be my carrying amount. This should be my carrying amount. Come to the non-current investment, that is long-term investment. Long-term investment. Long-term investment should be valued at what generally? Cost. But permanent decline in value. Permanent decline in value means we have to recognize that amount. Here actually cost is how much? 300 rupees long term investment, but there is a permanent decline in value and it becomes 100 rupees now, correct? Hence this should be classified, this should be classified as 100. Why? Because there is a permanent decline in value of 200 rupees. Permanent decline in value of 200 rupees. So now the next thing is we have to write one more point also. So 300, first of all, come to current investment. 300 rupees is my cost, 100 rupees is the realizable value. I will account under realizable value only, because whichever is lower I have to account. So difference is how much? 200 should be debited to P&L account. This 200 lakhs should be debited to P&L account. Here also 300 is my cost, but my revised value is 100 only. 300 is my cost, but my revised value is 100 only. So difference is 200 lakhs. This 200 lakhs should be debited to P&L account. Okay, this is what the answer. We'll go to the exact answer now. So what is the answer? X Limited invested rupees 600 lakh in the equity shares of Y Limited. Out of the same, the company intends to hold 50% shares for long-term period, that is 300 lakhs, and remaining as temporary investment, that is 300 lakhs, irrespective of the fact that investment held by X Limited only for 3 months. As per AS 13, emphasis on intention of investor to classify the investment as current or long-term. Even the long-term investment may be readily marketable. In the given situation, the realizable value of all such investment on 31/3/2017 becomes 200 lakhs. That is 100 lakhs in respect of current investment and rupees 200 lakhs in respect of long-term investment. As per AS 13, accounting for investment, the carrying amount of for current investment is lower of cost and fair value in respect of current investment for which an active market value generally provides the best evidence of fair value. So they are giving the accounting standard fully. Final answer is accordingly the carrying value of investment held as temporary investment be realizable value, that is 100 lakhs. The reduction of 200 lakhs in the carrying value of current investment will be charged to P&L account. That's what they are trying to say. Standard further state that long-term investment are usually carried at cost. However, when there is a decline other than temporary in the value of long-term investment, the carrying amount is reduced to recognize the decline. You have to write the story actually. They lost a copyright. Here, Y Limited lost a copyright which drastically reduced the realizable value of its shares to 1/3, which is quite a substantial figure. Losing the case of a copyright may affect the business and will the performance of the company in long run. Accordingly, it will be appropriate to reduce the carrying amount of long-term investment by rupees 200 lakhs and show the investment at rupees 100 lakhs. Since the downfall in the value of shares is other than temporary, the reduction of 200 lakhs in the carrying value of long-term investment will also be charged to the statement of P&L account. So ultimately, whatever I worked out, they are reading it in English. Okay. Next question. Come to the next question. This Innovative Garments Manufacturing Company Limited. There is an Innovative Garment Manufacturing Company Limited invested in the shares of another company on October 1st, 2016 at a cost of how much? At a cost of rupees 2,50,000. It also earlier purchased gold of rupees 4 lakh and silver 4 lakh 2 lakh on March 2014. Market value of March 2014 of above investment are as follow. So they are giving there is a company, garment company, manufacturing company. They invested 2,50,000 rupees in shares, 4 lakh rupees in gold and silver. They are investing 2 lakh rupees on 1st March 2014. Market value of the above things is given below. How much? Share 2,25,000, gold 6 lakh, silver 3,50,000. How above investment will be shown in the books of accounts of Innovative Garments Manufacturing Company Limited for the year ended 31st March 2017. Okay, this is the question. So first point is they invested in shares and also they invested in gold and silver. First we have to check investment in shares is for long term investment or short term investment. How they invested. Okay, that check you have to do it first. So long term investment or short term investment, what is the purpose of investment, that we have to understand. So question is not clear whether the Innovative Garment is invested on long term basis or short term basis. So you have to write two answers. For shares you have to write two answers. Okay, because shares may be held for current investment as normally for long term investment also. So in this case you have to write two answers. One is if the company is buying these shares for current investment, that is they are going to sell this immediately within 12 months, then this should be recognized by showing cost or realizable value whichever is lower. Cost or realizable value whichever is lower. What is the cost? Actually, what is the cost? 2,50,000 is cost. But what is the market value? Market value B is realizable value actually. Market value of shares is how much? 2,25,000. If it is a current investment, they should value by 2,25,000 rupees. Okay, got it or not? But question is silent. Question we don't know. From question we are not able to understand whether it is a long term or short term. So you have to write two answers. Like if it is a current investment, value by lower of cost or realizable value. Realizable value is not given, then take it market value. Okay, market value is 2,25,000, hence this should be valued by 2,25,000 rupees only. Okay, that should be your answer. That's what given here. Okay, just go through this answer. Whatever I said will be there. and also just go through this portion. Okay, then come to gold and silver. Gold and silver, in case of gold and silver, what assumption they are taking is, normally gold and silver means they will use it for long term investment. Long term investment means generally we have to value by cost only. That's what they are trying to say. If the question says it is for short term investment, current investment, then you apply cost or realizable value, whichever is lower. Okay, cost or realizable value, whichever is lower. But in case of question is silent, for gold and silver you always assume it is for long term investment, because that assumption only they have taken here. Okay, so shall we move to the next question? So next question is, ABC Limited wants to reclassify its investments in accordance with AS 13. What is reclassification? Long term to current investment, current investment to long term investment, long term to current investment, current investment to long term investment. That is reclassification, correct? You should know lower of what and what we have to choose. In case of current to long, lower of what and what we have to choose. In case of long to current, what is lower of what and what we have to choose, that we should know. Okay, now we'll go to the question. A portion of current investment purchased rupees 20 lakh to be reclassified as a long term investment, as the company decided to retain them. The market value of the on the date of balance sheet was rupees 25 lakhs. This is one portion. So they have a current investment worth of 20 lakhs. They purchased for 20 lakhs actually. Cost is 20 lakhs and they want to present it as a long term investment. Current to long term. Okay. How we have to do it? We will do it. And next, another portion of current investment purchased of rupees 15 lakh to be reclassified as a long term investment. The market value of the investment as on the date of balance sheet is 6.5 lakhs. Here also they want to change from current to long term. Cost is 15 lakhs, market value is 6.5 lakhs. And the next one is certain long term investments. Certain long term investments no longer considered for holding purposes to be classified as a current investment. Original cost is 18 lakh and it has been written down means carrying amount. Carrying amount is 12 lakh rupees. Okay, as per AS 16. 12 lakh rupees other than temporary decline also they said. So here long term to current. First two cases current to long term, last one case long term to current. Okay, we will work out this problem. So before working out, just we will understand the formula. So first one is long term investment to current investment. Long term investment to current investment. In such case, lower of cost and carrying amount. In such case, lower of cost and carrying amount should be the value of the investment. I am changing from long term to current investment means lower of cost and carrying amount should be the value of current investment. Next case is current investment to long term investment. Current investment to long term investment. In such case, lower of cost and fair value. Fair value is not available, then market value we can take it. If fair value is not available, then market value we can take it. So current investment, lower of cost and fair value should be the value of long term investment. So what is the first scenario? What is the first scenario in the question? What is the first scenario in the question? So first scenario in the question is what? So first scenario in the question is current investment purchased. Current investment purchased is, first scenario is current investment to long term investment. First scenario is current investment to long term investment. So current investment purchased and for how much, and what is the present market value, that is fair value. Current investment purchased for 20 lakhs, present market value is 25 lakhs. This is cost, this is market value, that is fair value. Okay, fair value is market value, you can interchange. Question is not, if fair value is not given, then you can consider assume market value is fair value. Okay, so lower of this one only we have to take it. So here the answer will be for long term investment should be valued at 20 lakhs. Okay, second scenario, come to the second scenario, or I will write here. So second scenario is what? Again, second scenario is current investment to long term investment. Current investment to long term investment. So what is the current investment is cost and fair value. Cost is how much? Current investment, just go back to video, you will get to know. Cost is 15 lakhs, market value, that is fair value, is 6.5 lakhs. Cost is 15 lakhs, lower is how much? 6.5 lakhs. Hence the long term investment should be valued by 6.5 lakhs. Long term investment should be valued by 6.5 lakhs. Then what is the third scenario? Third scenario is long term investment to current investment. Long term investment to current investment. So long term investment, what are the things is given for long term investment? Long term investment cost is 18 lakhs, carrying amount is 12 lakhs. Cost 18 lakhs, carrying amount is 12 lakhs. Okay, so cost is 18 lakhs, carrying amount is 12 lakhs. Carrying amount I will write again, it's not working. Carrying amount. Okay, cost is 18 lakhs, carrying amount is 12 lakhs, lower of these two is 12 lakhs. Hence my current investment value will become 12 lakh. Okay, this should be the answer. We'll go to the answer now. So what is the first one? In the first case, the market value of investment is rupees 25 lakhs, which is higher than its cost 20 lakhs. Therefore, transfer to long term investment should be made at 20 lakhs. Correct. Okay. Then what is the second thing? In the second case, the market value of investment is 6.5 lakhs, which is lower than the cost 15 lakhs. 15 lakhs is the cost, market value becomes 6.5 lakhs. Okay. Therefore, the transfer of long term investment should be carried in the books and at the market value 6.5 lakhs. The loss of 8.5 lakhs should be debited to P&L account. Yes, it should be debited to P&L account. Why? Because initially in my books I am valuing at 15 lakhs only. Cost is, because long term investment is normally valued at the cost. Long term investment is valued at cost, not long term investment is valued at cost. Current investment is valued at 15 lakhs is cost, and market value 6.5 lakhs means 6.5 lakhs. 6.5 lakhs only it should be valued, correct? So the difference of 8.5 lakhs should be debited to P&L account. Okay. Why? Because it might be valued at 15 lakhs. So what is the next one? Third one. In third case, the book value of the investment is rupees 12 lakh, which is lower than its cost rupees 18 lakhs. So book value is book value means carrying amount. Book value means carrying amount 12 lakh, cost is 18 lakhs. So the carrying amount only we have to take it. Lower of these two is 12 lakh, hence this should be presented in book value only. Okay. Already book value is 12 lakh. Now again you are reclassifying into 12 lakh. Okay. There is no impact in P&L account because already it is presented as 12 lakh only. Now again you are presenting into 12 lakh rupees. Okay. What is the next thing? So Suchitra purchased 1000 shares in Tip Top Limited of rupees 600 per share. Suchitra purchased 1000 shares in Tip Top Limited of rupees 600 per share in 2016. There was issue in 2018 of 1 share for every 2 held at a price of rupees 150 per share. If Suchitra subscribed the rights, what would be the carrying cost of 1500 shares as per AS 13? This is the question. So what they are saying, Suchitra already purchased 1000 shares for 600 rupees. In which company? Tip Top Limited company. Then what happened? Tip Top Limited is issuing right shares. When they are issuing 2018, they are issuing. How much they are issuing? 1:2. If you have two shares, I will give you 1 shares. What price they are issuing? 150 per share. Then what is the total carrying cost of 1500 shares? That is the question. So we have to work out this. We will work out. So existing shares how much? Equal to 1000 shares. Correct? 1000 shares is existing shares. Right share company is issuing 1:2. That means if you have 2 shares, I will give you 1 shares. So 1000 divided by 2 equal to 500 shares. 500 shares is the right shares. Okay. So what is the present price? Present price of the share is how much? 1000 into 600 is my present share price. Correct? 1000, that is 6 lakh rupees. Right share how much issuing? Buying from the company. 500 shares I am going to buy. What price? 500 into 150. Correct? 150 per share. How much will come? So how much? 500 into 75,000. Correct? So 6 lakhs plus 75,000, 6 lakh and 75,000. 6 lakh and 75,000 for how many shares? For 1500 shares. So the carrying cost of total shares, will be 6 lakh and 75,000 rupees. This is the answer. This is the 1 mark asked, 2 marks asked from your institute examination. Okay. So we will go to the answer, material answer. Answer is this is the answer. So 6 lakhs is the existing cost. Amount paid for right is 75,000. Total carrying cost is 6,75,000. 1000 into 600, 6 lakh. 500 into 150, 75,000. 1500 total shares, that is 1000 share plus 500 share equal to 1500 share equal to 6,75,000. So with this, the AS 13 accounting standard for investment is over. We will discuss new accounting standard in our next class. Okay, thank you.